Welcome to the Explainer. Let's jump right in, shall we? Today, we are taking a fascinating and highly structured look at IFRS 5. For those who follow this closely, you know this is the standard that deals with non-current assets held for sale and discontinued operations. Think of this whole process as a chronological journey. Imagine an asset, maybe a massive piece of heavy machinery, or even an entire division of a company, packing its bags and waiting in the company's departure lounge. It's getting ready to leave the balance sheet for good. But as we're going to see, gaining access to this departure lounge involves clearing some incredibly strict security checks. Here is our roadmap for the day. First up, the classification test. Second, the highly probable rule. Third, measurement and impairment. And finally, presentation and discontinued ops. Let's get right to it. Section 1, the classification test. Checking in. So starting off the first phase of our accounting journey, we have to figure out if an asset is actually allowed into that departure lounge. And I want to pose a crucial question to you. When is an asset actually considered held for sale? Management can't just wake up, look at an aging piece of equipment on the factory floor, and arbitrarily decide, yep, let's call this held for sale. It doesn't work like that. There are strict, uncompromising criteria that have to be met to shift an asset out of the standard non-current category and into this highly specific one. Take condition 1, for example. Notice the absolute strictness here. The asset has to be available for immediate sale in its present condition. What does that actually mean in practice? Well, if management says, we're going to sell this, but first we just need to do a few repairs, then it completely fails the test. It is not available as is. Or let's say you have an old laptop sitting abandoned in a cupboard. That's an abandoned asset, not a held for sale asset. What about a fire extinguisher sitting in the hallway? That's an asset on standby. Its very job is to be on standby. Neither of those qualify. It must be ready to go as is right this very second. Section 2, the highly probable rule, clearing security. Okay, so the asset is ready for immediate sale. Now we have to prove that the sale is a near certain reality, not just wishful thinking. To do this, management must satisfy 5 strict subconditions simultaneously. First, they have to be firmly committed to a plan to sell. Second, they must be actively locating a buyer, so no just sitting around waiting for the phone to ring. Third, the asking price actually has to be reasonable compared to its current fair value. Fourth, the sale is expected to be completely finalized within exactly 1 year. And fifth, the actions required to complete the plan indicate that it's highly unlikely they'll suddenly change their minds or withdraw the plan altogether. Miss even one of these, the asset stays exactly where it is on the balance sheet. Section 3, measurement and impairment, the way in. So, your asset has cleared security. It is officially classified as held for sale. The very moment that happens, you have to do a direct comparison to recalculate its value in the books. First, you calculate the asset's final carrying amount, accounting for all normal depreciation and impairment right up to that exact date. Then, you calculate its fair value less cost to sell. That is exactly what it sounds like. What you can actually get for it in the open market, minus the broker fees, the legal fees, or the transportation costs required to dump it. The crucial point here is that under IFRS 5, you must record the asset at the lower of these two figures. It is classic accounting conservatism in action. Now, what happens if your fair value less cost to sell is the lower number? Well, your asset just lost value. That difference is recognized as an impairment loss. And here's where you really need to pay attention. This impairment loss must go straight to the profit and loss statement. It absolutely does not matter if the asset was previously held under a cost model or a revaluation model. Under IFRS 5, that hit goes directly into your P&L. Which brings us to the absolute golden rule of IFRS 5. Once classified as held for sale, no more depreciation or impairment. The very second this asset enters our departure lounge, the depreciation clock just stops dead. You no longer charge annual depreciation, and you no longer conduct standard IAS 36 impairment reviews. And the logic makes total sense, right? You aren't consuming this asset's economic benefits through usage anymore. You're just waiting to realize its value entirely through a sale. I also want to quickly highlight a vital exception the source material points out regarding goodwill. If you're dealing with an entire group of assets, a disposal group, and you take an impairment loss under IFRS 5 that gets allocated to goodwill, well, that specific goodwill impairment can never be reversed in the future. Even if the value of the disposal group miraculously recovers later on, that goodwill impairment is permanent. No takebacks. Section 4, presentation and discontinued operations, the departure. All right, we know how to classify it, and we know how to measure it. Now, how do we actually present this offloaded asset to the shareholders reading the financials? So far, we've mostly been talking about single assets, like a piece of machinery. But what if we're selling off a massive chunk of the company? That elevates the disposal into what's called a discontinued operation. To meet this definition, the segment needs to be a separate major line of business, like a car manufacturer selling off its entire motorcycle division. Or it could be a separate geographical area, like totally pulling out of the European market. Alternatively, it might be a subsidiary you bought just to flip. It's really all about size and strategic significance. Pay close attention to how this looks on the statement of financial position. If the reporting date arrives and the discontinued operation is still unsold, it is completely stripped of its non-current title. It gets yanked out of non-current assets entirely. Instead, it's reclassified and presented within current assets, usually under a heading like Other Current Assets or as a distinct disposal group. And why is it a current asset now? Well, remember the highly probable rule? Because we expect to sell the whole thing within 1 year. And how does a massive discontinued operation look on the profit and loss statement? This is where it gets incredibly streamlined. You do not list out its individual revenues, its administrative expenses, or its tax burdens on the face of the P&L, alongside your continuing operations. Instead, it's a two-step process. Step 1, you present a single line item, just one line, showing the post-tax profit or loss of the discontinued operation. Step 2, you take all that messy, detailed breakdown, the revenues, the costs, the taxes, and you tuck it all away in the notes to accounts. Which leaves us with a final, rather provocative thought to wrap things up. By restricting the face of the P&L to a single line item and burying all the detailed financials of a discontinued operation in the back pages of the notes, does this standard truly give shareholders the immediate clarity they deserve, or does it merely prioritize a cosmetically cleaner P&L for management? It definitely forces the focused learner, the diligent investor, to dig deeper into those notes to see the real story of what is being sold off. Thank you so much for joining me on this explainer. Keep questioning the numbers, and I'll see you next time.